Hello, everyone. Today on the final bar, I'm joined by Mary Ellen McGonagle from MEM Investments. Always does a great job. She's a natural stock picker, is how I would describe her. Has a couple names for us to look at. The market really distributing into the close. You see the S&P pushing lower, broke 4,700 around lunchtime, but really pushing further down, closing just above 4,650. We'll look at sort of that weakness in growth and how it's dragging down pretty much everything else with it. Defense, utilities, the only sector higher. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of StockCharts, using the technical analysis toolkit to better quantify investor behavior by gathering the evidence using indicators of price and breadth and sentiment, focusing on trend characteristics, momentum swings, and where we can identify some opportunities. So if you're looking for indications of short-term bias, certainly plenty of distribution going into the close here. And you have to remember, I think in this sort of environment, it's a stock market, but it really is a market of stocks, right? Individual names make a huge difference. And even though the S&P is closing down 1.4%, it looks around that going into the close. The NASDAQ down 2.5%, which is certainly feeling some pain. There were plenty of names that were higher. I mean, if you look at the new highs list, or not the new highs list, but the biggest gainers, there are plenty of stocks that were higher. And a lot of these names are ones like cruise lines, like airlines. A number of these have been beaten down recently. These are names that have been struggling a bit, sort of bouncing higher. Even home builders are sort of teasing that potential of moving higher, but at some points, certain times struggling to do so. We'll look at all of those charts together and see what broad messages we can tease out. I'm excited to sit down with Mary Ellen McGonagle here in a few moments. She does a great job breaking down the charts and thinking about the markets using technical and fundamental analysis combined. Some great guests coming up for you in the coming weeks for sure, but a couple announcements to get to first. First off, tomorrow I will be off. I'm taking the day off. We're traveling very safely. I certainly hope to visit some relatives out of town. Aaron Swenlin has agreed to take the show for me. So Aaron Swenlin from Decision Point will be manning the final bar tomorrow. She does a great job with her show, and her shows actually co-hosts Chartwise Women with Mary Ellen McGonagle every week on StockCharts TV. So she'll be with you tomorrow, wrapping the week. Also, next week, we have the Charting Forward 2022. This is our main market outlook presentation. It's going to be next Tuesday, January 18th. You can go to stockcharts.com/2022 market outlook to get all the information. Gina Martin Adams from Bloomberg, Tony Dwyer from Canaccord Genuity, Linda Raschke, John Markman. It's going to be a fantastic group. Samantha Leduc, who's been on the show many times. Should be a lot of fun. Go to that website to get more information on the presentations and what to expect, but it should be a great way to make sense of the year to come. Also, we've had some other special events. Larry Williams did his market outlook last week. You can find that one on our on-demand platform. Also, Martin Pring's 2022 market outlook. Bruce Frazier sat down with Martin recently. We just showed that earlier today on StockCharts TV. Go to our YouTube channel if you missed it, or go to StockCharts TV on demand. And as a reminder, next Monday is MLK Day. We'll be taking the day off along with all of StockCharts, and we'll be back with you Tuesday for the final bar. Let's continue on today's show with our market recap. As I mentioned, quite a bit of distribution. If you think about a couple days ago, we had sort of that big run higher. Yesterday was the consolidation day. This is sort of this digestion phase. You know, you sort of have the big meal and then you have the digestion day where you sort of settle into an equilibrium. That's what yesterday felt like. Today, turning out to be much more distributive than the previous days, with the NASDAQ leading the way lower, down 2.5%, the S&P finishing down about 1.4%, and the Dow down about 0.5%. And if you look earlier in the day, it was sort of a familiar reality where growth stuff was down, the S&P was sort of flat, and the Dow was actually higher. But at the end of the day, what happened today, I think, is an example of, broadly speaking, what is happening to the indexes. It's difficult, and it will be quite difficult for the S&P 500 to make any sort of gains to the upside if the fan mag stocks or the FANG names look like they do here. We had Alphabet down 1.9%, down to Microsoft down over 4%, really selling off into the close. And it's really hard in a growth, a growth weighted benchmark like the S&P is, and certainly the NASDAQ, which is mostly growth names, difficult for those to perform well when the biggest companies in those indexes are struggling so strongly. So the good news is I think there can still be pockets of opportunity. Energy stocks only down 0.5%, financials down 0.4%. And many of those, when I screened for new highs earlier today, I saw plenty of names in energy and financials and in other sectors like materials, for example. So interesting how that short-term movement today is lining up with sort of the long-term things we've been talking about value over growth. Looking at some other asset classes here very quickly, interest rates coming off, actually started a little higher with 10-year yields getting above 174. By the end of the day, back down to 171. So a bit of a flight to safety of sorts with bond prices coming higher. That really hasn't been a trend that we've seen. It's been more about higher rates. But today's a bit of the opposite with bond prices going higher and rates coming down. The dollar index really flat from yesterday. But if you look at some of the signals we're getting from not necessarily gold, but certainly gold miners, things like Newmont mining, NEM, even things like BHP Billiton, with nice rotations higher, breaking above recent swing highs. And that really only tends to happen if you have a weaker dollar, which means the gold prices, a bit of a tailwind for gold prices to potentially go higher. Today, though, gold down and it had a sort of a V-shaped morning before recovering a bit of it, but finishing the day at about 1/3% lower. Oil prices coming off as well. Energy stocks were down about 0.5%, but commodities as a whole coming off. This is after a pretty significant run to the upside, to be sure. Cryptocurrencies almost all in the red today. We're looking at the 10 most liquid coins that we follow on StockCharts. Bitcoin got above 44,000 earlier today, but finishing lower, just above 42,500. Ethereum recently bounced off of the 3,000 level, touched 3,400 today and also yesterday, but now selling off a little bit, 3% lower from where it was yesterday. And then again, plenty, elevated volatility is pretty much the norm. Those are pretty reasonable days. There's actually calm days relative to the normal days you have in crypto land. Let's look at a chart of the S&P 500 to sort of set up where we're at. So we once again testing the 50-day moving average over the last week and a half. To yesterday, you sort of bounced off a couple days ago, closed back above 4,700 on Tuesday's session. Yesterday, open and close right around the same level. It's called a doji candle, which ends up usually being a short-term reversal pattern. Today, selling right back off, as we mentioned, with the weakness in the close. So we're not only we back below 4,700, which is that brown shaded area there that we've been talking about for quite a while. We're now closing back below the 50-day moving average. And, I mentioned in an interview earlier today, I was doing the Forex Analytics Face interview with Dale Pinkert. Dale's been on this show, and Blake Morrow, who runs Forex Analytics, does do a great job of, a lot of shorter term discussions focused on Forex and futures. But we talked about a number of different asset classes and I mentioned that the S&P last year ended up being the easiest trading strategy ever. Was buy anytime the S&P literally touched its 50-day moving average. You probably did pretty well over the next week or two on every one of those trades. The only time it didn't really work out was September, October of last year, where you broke down through the 50-day, and it took us about a month before we regained the 50-day and eventually regained that 45.50 level. Now that we're closing back below the 50-day, the question is, of course, does the 50-day provide support like it did through much of last year, or is this move lower that we saw, this first leg lower in the beginning of the new year, is this just a short-term bounce, a dead cat bounce, if you will, before the rotation lower? And I think the way you determine whether or not that's the case is focus in on a key level like 45.50. That's the resistance from early September. That became support in December a number of times. And I think as long as we remain above there, the overall structure of the S&P, you could still argue is fairly constructive. But if we would get below 45.50, that would mean that this weakening momentum picture is really following through. It's not just a lack of momentum on the upside. I think that's a notable issue with the push to the 4,800 level in late December. If we would get below 45.50, most likely the RSI comes below 40, and all of a sudden this feels like a much more bearish momentum picture as opposed to sort of a neutral one, which is where we're at right about now. So a lot of questions, I think, for stocks going into the holiday weekend. This weekend, tomorrow's session, of course, important, but next week for sure, coming out of Martin Luther King Day, and seeing what happens overall to equities. 45.50, I think, still a quite important level. When we look at at sectors, I mentioned utilities, really the only sector that was higher today, about 0.5%. Consumer staples and industrials, just a little bit above zero, but it was sort of an unchanged day. Everything else was lower, with tech, consumer discretionary, and healthcare really leading the way lower. When I screened for new lows earlier today, guess which three sectors I found quite a cluster of new swing lows? Technology, a lot of names rotating lower there. Some of them a little, newer than others, but charts like Shopify really testing support with some potential issues. Consumer discretionary, got a lot of names rotating lower, and it's things like Amazon, rotating to the lower end of the range. But Bath and Body Works, which had been a really good name, sort of breaking down, and others. And then healthcare, and some of the leading healthcare names, things in like supplies and equipment, for example, rotating lower as well. So within the growth-oriented areas of the market, I think it's really important now to be thinking about downside risk. And Charlie Kirkpatrick, who is one of my mentors, he taught the course at Brandeis University before I took it over from him. He also always used to say that risk is not volatility. Risk is downside capital loss, right? It's about making sure that you minimize losses, because all large losses begin as small losses. Catch your losses when they're limited and they don't have real destruction on your portfolio. We need to take a quick commercial break. We'll be back with today's guest, Mary Ellen McGonagle. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close as we focus on the market environment. We think about trends and momentum shifts and really, focus on the message the markets provide back to us. I'm Dave Keller, the Chief Market Strategist here at StockCharts.com. Really appreciate you joining us here on StockCharts TV today. A couple comments before we get to Mary Ellen McGonagle here in a moment. First off, we love to hear questions from you. We very much welcome feedback on our guests, on your host, on our whole operation, what we could do better. But we very much even more appreciate questions that you're running into. What are you running into as you are trying to analyze your own portfolio, your own positions, your trades, using the technical analysis toolkit and using the StockCharts platform. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. I mentioned some of our market outlook specials. If you miss any of those when we stream them live on our website, it's no worries. We have them all stored on our on-demand platform. It is a website, StockChartsTV.com. It's also on your mobile device. Just search on the app stores for StockCharts TV on demand. All you need is an email address. You can set up a free account, start watching all of our great content on demand. I want to welcome on today's guest, Mary Ellen McGonagle. Mary Ellen is a familiar name and face, I know, to many of you on StockCharts TV. She does a great job of hosting her show on StockCharts TV, also co-hosting Chartwise Women along with Aaron Swenlin. And Mary Ellen, it's awesome to welcome you back. Happy New Year, and thanks for joining today.
Oh, thanks for having me. Happy New Year to you as well.
Thank you. When we're thinking about this market, I think last year, if you describe 2021, rotational is an adjective I use a lot. It's, I feel like it was a really important year to focus on individual stocks and groups and themes. And you're better than anyone, I think, better equipped to help us focus on those. We're starting with FC Franklin Covey. Talk us through this one.
Yeah, so what I'm sharing today is this as well as another chart. My work is my background with Bill O'Neill. It's all about earnings being the primary driver of a stock's outperformance. And we are just now entering into earnings season. You talked earlier about the concept of sentiment. No better way to get your arms around investor sentiment than paying attention to these stocks as they come in with earnings. How are the markets? How are investors investors responding? So first up, we really only have a few names that have reported, and this company did happen to report last Friday, Franklin Covey. It's a smaller company, 700 million, but I think it exemplifies what we are feeling and seeing in the markets. The stock came out with numbers that were 550% year-over-year growth, 800% above estimates, and in an otherwise very difficult market last Friday, the stock gapped up 11% on very heavy volume. And so we are seeing a continuation rally. It's up 2% today. Your outside momentum indicators are positive. So we are seeing constructive response to companies that come in well above estimates and also guide higher. Management guided higher into next year. That's another key component. So that is not something that's absent in this otherwise very difficult period, but there are other factors to keep in mind in addition to those earnings. So we can take a look at that next chart, and it is another company that reported on Friday, AEHR Test Systems. Now, this is a semiconductor company. They also reported above estimates, 25% above estimates, 171 year-over-year growth. But take a look, the stock sold off very dramatically. And a couple of factors at play here. Number one, AEHR is sporting a PE of 296 times trailing earnings. So at this time, the markets do not have an appetite for those higher multiple stocks. And then also going into that earnings report, the company had been up triple digit. So big winner, a lot of profit taking. And thirdly, the industry group, semiconductor stocks are part of that high growth area that is currently not under favor.
Hey, listen, Mary Ellen, thank you so much for joining us. Really appreciate you sharing those ideas. And again, stay safe, be well there in Southern California. We'll talk to you again soon. That's Mary Ellen McGonagle. Mary Ellen is the founder of MEM Investment Research. She's also the senior managing director of equities for Simpler Trading. Hosts her own show on StockCharts TV. Also co-hosts Chartwise Women along with Aaron Swenlin. And I love that thought about making sure that you focus on the relationship between price and earnings. It's so easy. I feel like we're so caught up in these macro themes, these narratives about interest rates and the coronavirus and inflation. All of those are certainly important, but let's not forget that these are companies with earnings. And as we get into earnings season, those have the potential to certainly rock trends that have been fairly well established at some point. Great take there from Mary Ellen McGonagle. Let's continue on today's show with our next segment, Getting Sentimental. What we love to do around once a week is focus on some of the weekly sentiment data, see what themes we can tease out based on where things are at. And sentiment for me sort of has a couple different feels. Starts with volatility. And so we look at the options market to get a sense of what sort of volatility is being priced in. That's where we look at the VIX. We'll also look at some survey data, and we'll, if we have time, get to the put-call ratios as well. Another use of options to understand or to make some assumptions about sentiment for the underlying markets, the equities. When we're looking at the VIX, starting there, I think the reality of 2021 was we settled into a range of sort of 15 to 25, and 3 times really, if you get rid of the first quarter and sort of start with the second quarter of last year, getting above 25 indicated fairly significant pullbacks, probably the most buyable pullbacks in the bulk of the year. So you look in May, we had the VIX getting above 25 again in September on the pullback there, and then once again we got above 30 there at the end of November. Each one of those 3 times were some fairly decent pullbacks. 3 to 6%, if I remember right, but overall good buyable opportunities to ride that trend higher. But if you look on the lower end, we got down to 15 a number of times. That's when we were sort of in the midst of those swings higher. What's happened now, and I think what you have to remember is that 2019, we sort of spent most of our time below 20. 2020, we spent most of our time above 20. 2021 was sort of right in the middle. We sort of rotated around 20 as a midpoint, as a median level of the VIX. For that 12-month period. I wouldn't be surprised, given the headwinds that we have and given the competing narratives, all the macro themes that I mentioned, and as I was wrapping the discussion with Mary Ellen. I think the challenges for a lot of investors is going to be elevated volatility. I see this year as having elevated uncertainty as we deal with the Fed's change in policy. And as much as they've tried to telegraph what they're going to do, there's still a lot of unknowns, I think, in terms of how investors are going to deal with that reality, because we haven't seen a rising rate environment in quite some time. We haven't seen a Fed raising rates for quite some time. It's certainly going to be a different experience. For me, change means elevated uncertainty. Change also means elevated volatility. So I've mentioned a couple of times, I wouldn't be surprised if we spend more time with the VIX above 20 than below 20 this year. And having said that, we're right at 20 today. We just got right back above there with the drawdown that we saw for the S&P 500. So right now we're sort of, again, at that median range, median level for where we were really for the last 12 months for sure. From here, it certainly seems like we're seeing a trend higher in volatility. You can see the average level sort of pushing higher. And I think getting a VIX above 20 is an important note. If and when we would get above 25, that may identify a buyable dip, and that's what I would be looking for. When we look at survey data, we'll start with the AAII survey. That's American Association of Individual Investors, and that's looking to see whether the respondents are bullish, bearish, or neutral on stocks. And they're surveyed once a week. And the Thursday number that we got today, bulls coming down to just below 25%, bears increasing to just above 38%. That's a net negative reading or a net bearish reading of about 13.5%. That's sort of the lowest level that we've seen, or at the lower end of the levels that we've seen, really until you go back to 2020, where we saw the net negative reading for quite some time as there was this disbelief phase on the initial push out of the March 2020 lows. Look at how the number of bulls, or the percentage of bullish respondents, has really steadily declined over the last 8 or 9 months. Every time we've pushed higher, there's been less and less bullishness using the AAII survey. At this point, if you look at the bullish reading, we're at the lowest levels we've been since back in that period. So we are sort of returning back to what was sort of a disbelief phase, sort of this skepticism of market upside. I don't think of that as sort of a natural bullish indication. I think that is sort of an area of concern, suggesting that a lot of investors are not really buying into the recent upswing as the S&P attempted to get above 4,700 and 4,750. Now, the name exposure index, instead of looking at individual investors, looks at money managers. And here we can see the name exposure index coming in at 75%. That's down from where we were at the last couple of weeks, but really mid-range for the last year and a half or so. So I see this as sort of a fairly constructive kind of middle of the road value. Getting above 100% suggests money managers are net leveraged long and can be a concerning pattern. We're not necessarily seeing that here today. Put call ratios, no need to spend any time on this because I don't think they're giving us a very clear signal. The put call ratios, I think, are really meaningful when they get to extreme highs, extreme lows. It's sort of in the middle as we're chopping around so far in early 2022. That is our Getting Sentimental segment, focusing on market sentiment readings. And again, I think the VIX is the most important chart of that bunch to be focusing on now. We need to wrap today's show, though, and go to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is AT&T. Had fun talking stocks with Mary Ellen McGonagle today, and I'll share a couple tickers that have surfaced for me today as I was looking at some names earlier today for my market misbehavior premium members. AT&T, if you look at it on an unadjusted basis, so to underscore T, and you take the high from last May, you take the low from last month in December, we have just broken above the 38.2% retracement of that 6-month sell-off. That's an interesting recovery with AT&T going from 22 up to almost 27. This is a name that yields over 7% with a fairly significant dividend. So an interesting recovery on AT&T, some of the traditional telecom names there. Chart number 2 is Newmont Corp, NEM. And I was mentioning earlier about the rally that you've seen in some of the gold names. You really don't see it necessarily on the GDX yet. GDX is sort of in the middle, sort of consolidating still. But charts like Newmont Mining, I think, have had a bit of a rotation from a distribution phase to an accumulation phase. And what I mean by that is you've gone from a pattern of lower lows to stable lows to higher lows. You've gone from a pattern of lower highs to stable highs to higher highs. So that is a classic Dow theory rotation from distribution phase to consolidation phase to accumulation phase. I love nice orderly rotations like we're seeing on the chart of Newmont Mining. Now, why is Newmont Mining and other miners not done well up until now. The biggest problem has been the stronger dollar that we saw through much of 2021. 2020 saw a weaker dollar, 2021 a very strong dollar. Now all of a sudden in the last 6 weeks or so, we're seeing a bit of a rotation. You're seeing the euro start to work and strengthen versus the US dollar. Weaker dollar means that gold can actually start to flourish. That's why gold has not rallied, even though inflationary pressures have been more and more obvious, I think, to a lot of investors. So we could be in that weaker dollar phase, which could be a nice tailwind for charts like Newmont Mining and others. So I like the rotation higher, the relative strength starting to improve on any sort of chart like this. We have a basing pattern and you're bracing to new highs. I like to focus on that breakout level, which is just around 59, we'll call it. Remaining above that breakout level, and look at how we had resistance. We broke out, we retested that breakout level from above, and now rotating higher. Holding 59, I think, is an important feature there, and we're just above the 200-day moving average. Let's make sure we hold above there as well. Finally, we have Starbucks, just like Newmont is rotating to new swing highs. Flip that chart over. You have the chart of Starbucks. I read the article earlier this morning that people put over $3 billion on Starbucks cards over the holiday season, which is more than some of the regional banks we talk about when we're breaking down the financial sector. It's an incredible amount that people are putting on gift cards. However, the Starbucks stock, the chart is not reflecting that. It's a great reminder to separate the narrative, separate the news from what the chart is actually telling you. I'm seeing a chart that's breaking below support. It bounced off of 105, didn't quite get there in mid-December, but attempted to regain those previous highs, failed, and now is breaking down through support. On a chart like this, two levels I would be paying attention to, particularly on the tactical time frame. 100, big round number, tends to be important. And then 96, which is a 38.2% retracement, lines up really well with that low from the end of January if you take the overall larger structure. So an interesting breakdown and potential areas of support for Starbucks. That's our show for today. Special thank you to Mary Ellen McGonagle joining us from LA and sharing some thoughts on some individual stocks with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.